Asia is 2/3 of the investable equity universe outside of the United States. It's a significant region that investors need to take note of.
Welcome to The Alternative Investor, the definitive show for investors seeking private alternative investments. Here's your host, Matt Johns.
Today, I had the opportunity to speak with an industry leader who has a very unique perspective. Gene Reilly is the founder and chief investment officer of the hedge fund Greenwich Quantitative Research, where he brings more than 3 decades of experience trading, investing, and managing risk across geographies, asset classes, and market structures. Notably, they bring a special expertise on Asia-Pacific markets. And Gene gained a lot of that experience during his 19 years living and working in Asia. He served as head of Pan-Asian equity trading and partner at Goldman Sachs, where he developed and scaled a highly successful quantitative trading business. He later returned to the U.S. serving as global head of quantitative trading at Bank of America Merrill Lynch, where he helped pioneer algorithmic and automated trading. He also led profitable proprietary trading operations in Japan for Deutsche Bank. Needless to say, he has a rare global lens on market behavior. Today, we dove into Pacific Asia and the dynamics between East and West. We discussed markets, technology, even the evolution of global trading. It was great to get Gene's first-hand perspective on that part of the world and how it may impact us here in the U.S. Welcome to my conversation with Gene Reilly. You're living on the U.S. East Coast right now, and you've lived here for a number of years, but you spent a long time in the Far East, in China and Hong Kong. What do you think you miss the most from your time living over there?
Oh, really? That's a great question. Listen, every place is great. Of course, you miss the people that you get to know, and the food and the culture, and had a fantastic time living in Asia, and I have the opportunity to get back, from time to time, and of course, it's great to be back in the United States and have the great outdoors and the ocean not too far away. So it's all good.
That's good.
What was your blessed that way?
What was your go-to food when you were over there?
Oh, it's interesting. When I moved to Japan, I probably knew about sushi, but I moved to Japan in 1994, and what's interesting is the cuisine is very specialized in Japan. So a sushi restaurant only serves sushi. A tempura restaurant only serves tempura. It's amazing how specialized the restaurants are in Japan, and how many different sub cuisines there are that sort of exist in every one of the Asian countries, and also people take it really seriously. So it's a big part of the culture.
You spent a long time. You spent almost 2 decades over on that side of the world, and I think that was just your working life, right? You lived in China before you actually worked out there, right?
No, I visited China. Kind of my background in terms of moving to Asia, Matt, was very interesting. I started working at the Susquehanna Investment Group straight out of Wharton, and I had a meeting after meeting. They said, "Hey, Gene, could you stay here, and we'd like to catch up." And they offered me a position to move to Japan circa 1994. So off I went to Japan, pre-internet, pre-cell phone. Didn't speak any Japanese. When I got there, I went to the supermarket, couldn't tell you what half of the food was. If I wanted to get the newspaper, I had to go to Tower Records and pay $25 for a week-old copy of the Sunday New York Times. So it was quite an adventure. I didn't think I'd be there very long because I was there on a classic 2-year assignment, and wanted to get to China to see what that was all about. So made a first trip to China in 1995. It was all bicycles, dirt roads, low-rise buildings. A real window into what the country probably had been like for the previous 50, 60 years. Didn't think I'd ever be going back there professionally, and of course that was wrong. By 2000, a mere 5-6 years later, China was booming. Went back again in 2003. The landscape was entirely unrecognizable. The city that had previously been a 2-story, 3-story city was now covered with skyscrapers. There was significant traffic and a lot of business going on, and a rapidly developing stock market. By 2004, the firm I was at, Goldman Sachs, the CEO Hank Paulson won approval from Wang Jishan to have the first foreign-controlled investment bank in China, and one of the things I needed to do is to build a trading business there. So by 2004, we had architected an equity trading business in China, and I had a team of proprietary traders that were reporting to me there, and we were, following every twist and turn of that market, as well as visiting the country, every quarter to manage that operation. So it was really a crash course in the development of Chinese equity markets from the ground up.
There really couldn't have been a whole lot of other people doing what you were doing at that time, right? The American market, the American financial system had not made its way into China like we know it today.
Sure. Now, Goldman Sachs, got the first license to move into China. So, we were absolutely first, and there was a real strong sense that what we were doing there was very pioneering, and it was a great era. We would meet with the Chinese regulators on a regular basis, and they actually were very interested in what we had to say. Times have changed.
But you were essentially one of the first equities traders, American equities traders over in China, right?
Yeah, that's probably true. There were very few people there focused on the equity market at that time.
Yeah, well, one of the reasons why we wanted to have this discussion today was because there's so much talk about what's happening in China right now in our U.S.-China relations, and especially with the economy, the tariffs, all that kind of stuff. But I think we need to really look at the Asia-Pacific region as a whole. How would you define that sort of at a macro level?
Sure. I mean, we do this. We have a fund that invests across, the entire geography in Asia. So we look at the MSCI Asia Pacific index as kind of the definition of the universe. And that includes everything from, China, Japan, Korea, down to Australia, New Zealand, including India. So it's a very diverse region from that perspective. And, we believe it's a very important region. And we also contend that many investors, particularly U.S. investors, non-institutional, have very little exposure to this important region. But maybe I'll stop there. I can certainly recap the kind of the key economic statistics of the region, for your listeners.
Yeah, sure. Did you want to provide those now, or?
Sure, why not? It kind of sets a good stage for the conversation. I mean,
Yeah.
if we take a look at, first let's start with population, and if you can put a heat map in that we use later so people can see it, it's 56% of the world's population lives in Asia. When you visualize that, in terms of what that looks like relative to the rest of the world, there's a lot of Asia in the heat map. India and China are huge countries, each with over 1.4 billion people each. From a macroeconomic perspective, Asia is approaching 40% of global GDP, so it's the largest region in the world from a GDP perspective. From an equity markets perspective, equity capital markets perspective, Asia is only, at times has been about 25% behind the Americas. It's roughly twice the size of Europe from an equity market capitalization perspective. Also, the amazing thing about Asia is it trades a lot. And there's a big retail component of that, which we can come back to, which, people might be surprised by. But Asia currently, trades as much as 5 times more dollar value on exchange, than Europe does. So, that's a big change. And that's happened over the last, 10 plus years. If you look at, the world, kind of from a systematic perspective, we would argue that Asia is 2/3 of the investable equity universe outside of the United States. So, it's a pretty significant region that investors need to take note of.
Well, and when you think of it from a population standpoint and per capita standpoint, it would make a lot of sense that we would have that, but we don't perceive that necessarily from a financial standpoint.
It's interesting how things have changed. Absolutely. People were talking about the Asian century, and it sort of just snuck up on us. From a market capitalization perspective, these markets are large. They're very liquid. Retail participation is also very high. So you see significant retail participation in markets, even though, I'd say probably the absolute number of households that are invested in the stock market in Asia is lower than it is in the United States. Those who are involved in the equity markets are quite active. So 75% of the turnover in key markets like China, Taiwan, is retail. I would say the equity turnover in India is also very high, probably, in terms of straight equities, around 50%. But, another fact that people aren't necessarily aware of is that the Indian market is actually the largest equity derivatives market in the world by contract
Is
volume.
it?
Yeah,
Wow.
India trades 84% of all listed equity derivative contracts. Asia trades 86%. The U.S. is the balance. Now, that said, the contracts are smaller from a notional perspective, but in total, it's an enormous amount of volume. In that market with very high retail participation. And I do think that a lot of investors in the United States, aren't really aware of how significant the liquidity is and how actively traded many of the stocks in Asia actually are. It's a vibrant trading environment, really kind of across the entirety of the region.
You talked a little bit about the metrics behind it, but from a mentality standpoint, from a mindset standpoint, what do Westerners miss that is present in the Far East, in the Pan Asia region?
I don't know necessarily if it's something that they miss. I would say one thing that's kind of very true about the market. The equity markets are less institutionalized from a retail perspective, and when I say that, the large retail complexes you have in the United States, like Fidelity, Vanguard, iShares, BlackRock, doesn't really exist to the same extent in Asia. So a lot of investors actually prefer to make their own investment decisions. They like to research their own stocks and construct their own portfolios, more so than entrusting that to quote unquote professionals. There's a lot said about whether that's good or bad, but I do think I think there's a strong cultural preference on the part of many investors in Asia to be in control of their own portfolio, and I think that explains why the retail volumes are so high.
You've seen this Chinese market evolve over. You were there for 19 years, or there in that area of the world for 19 years. But you've been back here for a number of years after that, too. So you've watched this evolution from the inside at first and now from the outside. You've seen a lot of different things. You see this you've mentioned that you see this as a really good opportunity for market neutral investing. What does that look like, and why is that?
I think it's just the size of the market. There's a lot of opportunity. We quantitatively look at over 20,000 stocks. So we have the ability to have a forecast on over 20,000 stocks in the region. From a liquidity perspective, maybe we can, about 7,000 of those stocks have enough liquidity for us to actually invest in. But for the ability to put together a very diversified portfolio, and as you know, diversification is what people say is the only free lunch on Wall Street. We have the ability to construct a portfolio, of approximately 500 names long, 500 names short across multiple countries, multiple sectors, multiple industries that give investors a real way to preserve their capital, but also, we're able to, find very unique ideas and opportunities across that large universe.
Can you explain maybe the short trades in China too? Because I understand you'd mentioned it's a little different. I'm not sure I understand it. So can you please explain that a little bit?
You're not alone. We meet with some of the largest investors in the world, and that's a topic that we talk about quite a bit because it's relatively new. Really, the ability to short stock in China is only 5 years new, and we've written if your listeners are interested, we've written a white paper on the evolution of the market microstructure in China, so why it's suitable for market neutral investing, which kind of gets into the real detail. But we've gone through multiple iterations. I mean, when we first started looking at the Chinese equity market back in 2002, 2003, when we were considering entering the market and establishing an onshore presence in China, it was very hard to even buy stocks in China. If you were a foreign investor, you had to get what was known as a QFII. That QFII had to be approved by the Chinese regulators. Your foreign currency purchase had to be approved by SAFE. Once you funded that QFII, you could buy Chinese stocks. You couldn't short them. That went through a number of iterations of becoming easier to use. And then back in 2017, our friends at the Hong Kong Stock Exchange, in partnership with the Shenzhen Stock Exchange and the Shanghai Stock Exchange, developed what they call Hong Kong Stock Connect. And now investors have the opportunity to send orders to the Hong Kong Stock Exchange, and those orders are then onward routed to the Shanghai and Shenzhen Stock Exchanges for execution. And it really was that evolution to allow the Hong Kong Stock Exchange to act as a conduit for for trades into China, that the stock loan market and hence the ability to borrow stocks and short them in China, developed. So it's really it's really relatively new. I would say you couldn't say it's cutting edge anymore. It's 5 years new, but the extent to which international investors are taking advantage of the opportunity to have equity market neutral portfolios in China is it's still not fully extended into people's portfolios. And China's a complicated place. We talk to people about the different geopolitical pros and cons of China, and we say that it's a vibrant equity market. There's a lot of opportunity, and market neutral is a way to have exposure to some of those great stock picking opportunities without necessarily taking a directional position on the overall market, which is what we're able to do for investors.
Okay, I want to ask about something, and you just tell me if you want to talk about it.
Oh.
I can't think of the word for it, though. I was trying to think of it while you were talking. But these companies that'll create an ability to invest in the companies here in the States, but it's really done through a Cayman kind of setup, and you're not actually buying shares in the company itself in China. Do you know what that's called, or what am I referring to?
Those are a lot of the listings in the U.S. are done by VIE structures. It's quite
VIE
technical.
structure, that's it.
And one of the interesting things about those structures is that your actual claim on the ownership of the company has never really been tested in a kind of a deep legal way. So it's a very interesting construct. I would say the bigger issue with Chinese companies that are listed in the U.S. And this is something that I think a lot of people, even in the mainstream financial media in the United States, don't necessarily understand, because they talk about lower quality Chinese companies. Is that despite some of the really big listings like Baidu and people who have come to the United States for different reasons, some of the reasons that Chinese companies come to list in the United States is that China has actually tougher listing requirements, both in China on the Shanghai and Shenzhen stock exchanges and the Hong Kong Stock Exchange, than the U.S. does. So, for example, neither Facebook nor Amazon would have met the profitability requirements to have listed in China or Hong Kong.
Why?
Because they're looking for certain years of net profitability. They're looking for a certain number of years of certain cash flow metrics to be able to list. So companies that are kind of go-go growth companies, where we all believe that they're going to be very successful companies, just don't have the numbers yet, and therefore they would be considered premature for a public listing in China and Hong Kong. So tougher listing standards. And of course, listen, there's been cases where, some early internet companies, didn't do very well, despite having very large IPOs. So there may be some wisdom in it, but it has certainly created a situation where quite a few of the listings of Chinese companies in the United States were, in fact, companies that, couldn't have listed in China or Hong Kong because of those tougher standards. And maybe shouldn't have listed here either. And of course, that's a problem for investors, and certainly has had some reputational impact for Chinese equities in general. There are a whole host of other issues related to audit and accounting that are ongoing now with regards to where these stocks should be listed. But I think the general trend now is probably towards more Chinese companies listing, in China or Hong Kong. At least certainly that does appear to be the regulatory direction that the Chinese regulators are trying to move things right now. And I think to a certain extent, I think the U.S. regulators as well. That'll solve a lot of the issues around audit and reach into into potentially sensitive information that's being discussed as well. So, but that's the that is kind of the answer that for growth capital. U.S. listing requirements are just much more friendly than they are in other countries, especially Asia. And listen, that's probably one of the reasons why the U.S. has such a thriving tech sector, is that those early stage companies can get money at an early stage. But it also explains why not all of those listings have a happy ending. Is also part of the story.
Yeah, and you're talking about tech right now too. I want to get into that in just a minute here, but first I do want to touch on tariffs, because that's such a big talk right now. We're seeing the implications. Maybe you can help us understand what are the implications that you're seeing, not just in the public markets here, because we're obviously talking a lot about the public markets here in the United States and those implications, but with respect to Asia, what are you seeing as far as where money is going to be moving over the course of these until it's resolved in one way or the other?
It's a great question. The reality is, we look at, of course, across the entire 20,000 stocks we look at in Asia, we have data that goes down to, their supply chain and sales information. So we understand who they're supplying. We understand who their suppliers are. We understand how their sales break down geographically, including to the United States. So it's one of the tools we use to identify stocks. So if we do see stocks having significant exposure to the U.S. from a perspective of a large percentage of their sales, we can appropriately risk manage those in the portfolio. I think right now where we land long run is still very much a matter of there's a fair degree of speculation as to where it lands. I don't think that the tariff story for that reason is fully discounted in the markets, in the sense that there's a reasonable probability that the tariffs aren't in a year where they are nominally discussed being right now. So we sort of see how that works, but we are certainly focused on it. There are a number of large companies in Asia, and that this would have been highly problematic for, and those were the ones that were that had the exclusion. So the exclusion on mobile phones and semiconductors, really were important, because U.S. companies like Apple is very dependent upon Asia for its supply chain, specifically China and Taiwan. Companies like TSMC, essentially provide the world's semiconductors across dozens of businesses. The tariffs, to the extent that they had discussed, in those sectors, would have been very debilitating. And it didn't surprise me that modification came out, what was it, a week to 10 days after the initial tariff announcement, because, we did the math on Apple, and there wasn't a very good outcome if Apple was going to be subject to 100% plus tariff on 100% of their China produced products, and right now the vast majority of their products are excluded. But we're on top of the issue. There's certainly going to be money for investors to make on the long and short side as it relates to deeply thinking about these issues and reflecting them in their portfolios.
In general, I think the gist I'm getting from all this is you're still pretty bullish on China, regardless of anything that's going on. You're seeing a lot of opportunities there, regardless. What are you seeing, and why are you feeling kind of that sentiment? Or am I wrong? Maybe I'm wrong.
We think China's one of 13 markets that we invest in, and one of the things we love about Asia is that not only do we get to have a diversified portfolio of stocks, we get to have a diversified portfolio of countries. So we get to have positions across this very diverse and uncorrelated region. As it relates to China, China's a big economy. There is a lot of really interesting things going on in China. Some of the companies there are absolutely phenomenal. There are some companies that aren't great. It's a amazing environment for stock picking. You also have very high retail participation, so you have a market that moves quickly. Mm-hmm. There are dislocations, and there's opportunities to find great entry points into stocks that you like, or stocks that you'd like to short. If the market becomes too exuberant. So there's a lot there. I mean, if we dive into individual names, I think a stock that, I've been talking with people a lot about recently that is getting a significant amount of interest is BYD. And, if your listeners haven't heard about BYD, you're going to hear about it a lot more going forward. This is a company that Warren Buffett invested in a long time ago. I believe he is exited, but they started as a battery producer in China. They are now the world's largest producer of electric vehicles. And they're producing a vehicle that is very equivalent in quality to the Tesla Model 3 at approximately half the price. The last time I was in both Hong Kong and Abu Dhabi in the last couple of months, ordered Uber. The car that showed up was a BYD, and super high quality. I mean, just a great car all around. And they're set up to start exporting, significant volume. So you're going to hear about that stock. Xiaomi is another company. They're actually the world's largest producer of smartphones. They make a great smartphone product. Their market share in the U.S. is tiny. Their market share in the rest of the world, ex the U.S., is quite large. If you haven't heard of them, you'll hear of them at some point. So there are a lot of great companies in China that are worthy of consideration. Additionally, I think the other major trend we're going to start to see is going to be similar to what happened with Japan in the 80s. And if you go back and you kind of understand the Sony story, Sony started out as a OEM producer for U.S. brands, where they produced products that they produced, and they were branded by other companies elsewhere in the world, and they became a very efficient manufacturer. But they decided that they would launch their own brand and sell consumer electronics under the Sony brand, and people know how that story ended. It became a significant and very important global company. I think a lot of Chinese entrepreneurs understand that lesson, and I believe quite a few Chinese companies are now going to work towards developing global brands and design and market their own products under their own brand names, as opposed to purely manufacture on behalf of international firms. And I think that's going to produce another significant opportunity for the Chinese equity market. As areas that are great. And then I think there are quite a number of companies in China that are quote unquote state-owned enterprises, some of which are very well-run companies, and some of which are overly bureaucratic, and they're not. And I think you could have a very much like you saw in the 70s through the 90s in the United States, kind of a new economy versus old economy stock performance story play out, that there's just a lot happening in that space. Of course, we trade a lot. We're more short-term orientated, but I think these major trends will create opportunity. But I think if you look at some of the top market cap companies in China, not unlike the United States, they weren't around 20 years ago. I think there's significant opportunity, and I would say everything I just said applies to India as well. There are enormous things going on in India right now. Some very interesting companies that are being developed. There'll be some Indian companies that will be household names that in the next 10 to 15 years as well. So it's a very, very interesting and exciting time.
That's really interesting, especially with the recent visit by the vice president over there and trying to establish those relations and maybe make them a little bit more robust. So we'll see what comes of that too, and especially with that, with the new the new companies that are going to be coming forward from all that too. But I do want to come back to China really quick, because we were talking about the tech earlier, and that's one of the big. I guess it's one of the areas of excitement, but it's also an area of caution for a lot of reasons. I mean, you've got IP issues for one, right? That American firms are manufacturing over there, and they're worried about losing their IP and not being able to recover it legally. There are security concerns, of course, but this AI revolution is really kind of bringing it to light in a new way. We saw it with TikTok. TikTok was really driving a lot of that privacy concern thing, but now what we're seeing with like DeepSeek coming out and AI, there's really you referred to it as kind of a new space race, right? There's kind of this new race between the United States and China, especially in the AI front. Now, what's your take on that, and how are you seeing that playing out?
It's a big topic, Matt.
Uh-huh.
And thanks for raising it. No, it's very important. I think it's important for people to understand it. There's a concern, obviously, broad concerns around how powerful AI is, and it can be used for good. It can potentially be used for bad. So certainly, I think there's a strong sense that people would like to keep that artificial intelligence technology within the United States, and ensure that it's being used for good. But this is powerful technology. Quite frankly, every country in the world is going to want it. I believe that what we learned with DeepSeek is really that the measures that were being taken to restrict the export of more sophisticated semiconductors to China, is not in and of itself, the solution, or potentially maybe there isn't a solution, to necessarily winning the AI race. I think what DeepSeek demonstrated was that a smaller company with significantly less computer power was able to find a novel and innovative approach to produce results that approximated the results of larger companies using a lot more computer power by taking an innovative approach. And it had massive ramifications, for the stock price of NVIDIA, which has subsequently recovered largely. But to a great extent, I think, the conclusion is that it's going to be much harder to contain this technology, that there are a lot of smart people in the world, and that they will find ways to innovate. And, the use cases for artificial intelligence, are going to be so prolific that, we're going to be consistently surprised over the coming years as to how it's being used. And I don't think there's any way to put that genie back in the bottle.
No, that's long out. Yeah, but as far as let's just say diplomatic relations or relationships between the two countries, and maybe if you don't want to dive into this, just let me know. But between the two countries, how do you see this playing out? Because you've got two essentially growing superpower in China, and you've got an established superpower in the United States right now. How do you see this dynamic playing out where both are fighting for the highest levels of technology right now?
Well, listen, I think it's going to be the type of competition for technical innovation that we saw during the space race, in which there's breakthroughs on both sides, and the spin-off benefits and the externalities of this amount of research is going to be probably a net good for everyone. There's going to be a significant benefit to society of this technology proliferating. And we're going to see surprising innovation from directions that we haven't expected. So I guess to quote an investor that I know in Hong Kong, and if he listens to this, he'll know it's his line. He would say, "Never be short the Chinese entrepreneur, and especially don't be short the Chinese tech entrepreneur. They are a resilient group, and will surprise us with their ability to innovate." So I guess the bigger question would be, how can we sort of reach a global understanding on the use of artificial intelligence such that we don't, that there isn't the need to restrict the chips. I think that probably is going to be where this conversation evolves, because it doesn't appear that just restricting access to certain classes of semiconductors is going to be necessarily the answer to the issue. I think that's really what the world has learned from DeepSeek.
And we're seeing kind of this decoupling from the United States and China right now. Is that going to drive more innovation if it keeps going? What do you see with that?
When you say the general decoupling as it relates to tariffs, or
just in the U.S. is clearly establishing that there's going to be less dependency on China, or it desires less dependency on China at this point. And from a national security standpoint, maybe that's necessary. But China, on the other hand, is highly dependent on the United States consumer, right? So right now, the way the political divide is looking is that there's kind of this decoupling happening. do you see, if that continues, do you see that increasing the Chinese entrepreneurs' ability to influence? Do you see, I don't know, what do you see happening there between the two countries?
It's that's a really tough question to forecast on. I would say a couple of things. I mean, we've already seen since 2016. We have seen China become, as in terms of their total exports, they are more diversified than they had been historically, and a larger percentage of their exports, I believe, over 80% of their exports are ex-U.S. right now. So some number in the teens is to the United States. I think if we look at companies within China, individual companies have more or less dependency on the U.S. Areas where we are very dependent on the greater China complex is in tech. And, I think if you look at the products that were excluded from tariffs, it kind of answers the question as to where the pain points are in the U.S. And that's
a great point.
That's largely phones and semiconductors. Those are the tariffs that would have hurt us, probably as much, if not more, than it would have hurt China. And that's why we saw those exclusions. We've heard commentary that those exclusions are intended to be temporary. Very hard to understand how that. Very hard to understand how we resolve that in the medium term. So I think it's an issue of utmost importance to investors, and very, very important to kind of think about. People. And listen, I think Apple's a great company. People would ask me, historically, they'd say, well, doesn't it seem, very risky to invest in China? What happens if the relationship between the United States and China deteriorates? What would happen to the stocks in China? And I said, well, do you have any Apple in your portfolio? They said, of course, we love the stock. And the reality is that Apple's supply chain is entirely dependent upon the China-Taiwan complex. I know there's a lot of discussion around moving manufacturing to India. What they're really doing is they're moving assembly of phones to India, but all of the components that are going into those phones are coming from China or Taiwan. So, if there was a case where the door just got slammed shut, no more phones, no more laptops, no more of the semiconductors that are in so many products that that people use. So when you think about it that way, there's risk there's risk in both equity markets, and there's risk for both companies of these issues not being well resolved.
Now, are there any metrics right now or indicators that you're looking for that can give you kind of that harbinger of what might be coming?
Yeah, it's a great question. I would say, we tend not to really talk about the world from a directional perspective because, from our perspective, we find opportunities both on the long and short side. We ultimately balance our portfolio, and we make money for investors by being long a great group of stocks, being short a group of stocks that we think are, need to be marked down. And as a result of that, if we're correct, that's a great return for investors in which they should be able to make money in markets, whether the market's up or down. In terms of forecasts, which, just caveat, I say that because I want to caveat that forecasting market direction is not really our business. I think you have to talk a little bit about, China, being sort of the elephant in the room in Asia, and a lot of discussion around China and their real estate crisis. What doesn't get a lot of attention in the United States is that it does appear that China is now taking this situation much more seriously. China has announced in two stages, in September and November of last year, a really massive stimulus program. I mean, $2 trillion, equivalent to about 11% of GDP. It is essentially the same size as the stimulus response that the U.S. government ultimately implemented post the subprime crisis with the failure of Lehman Brothers that led to significant significant, positive impact on asset prices, in the United States. And what we're seeing at a nominal level in China, you could argue about what the multiplier is going to be, but at a nominal level, these are big dollars. This should start to have some effect, and I think there is a solid floor under the Chinese equity market that I think a lot of international investors have not necessarily realized. The other observation I'd make that kind of just breaks it down a little bit for your investors, prior to that stimulus being announced, let's say September 1st, 2024, if you took the top 3 stocks in the United States, which at the time from a market cap perspective were Microsoft, Apple, and NVIDIA, and added them up, that was about a $10 trillion market capitalization, which would have been equivalent to the market cap of every listed stock in China. So, when you think about it from that perspective, there's a lot of productive companies that you could buy for the same price that you could buy the top 3 companies in the United States for. And maybe that will be the case in 10 years from now, that the top 3 companies in the U.S. could pay for the entire Chinese equity market. But I think most people that we speak to think that we've seen a relatively cyclical low for China vis-a-vis comparative valuation, for U.S. companies. It's just something for people to think about when you kind of think about that. But China's only one country within a very robust region. I mean, Japan has been, Japan's equity market has been doing extraordinarily well for the last several years, and that will most likely continue. And there's significant innovation we're seeing kind of across countries, across companies, across the entire region. So there's really very interesting stories in every one of these individual countries.
What a great perspective on a side of the world that we so rarely see from this angle. And really appreciate the work that you're doing, and hope that we can connect again soon.
Well, Matt, thank you. I guess this is goodbye from Greenwich, Connecticut, and I look forward to coming down and seeing you in Texas again in the near future.
That sounds great. Looking forward to it.
All right, thank you.
We hope you have enjoyed this episode of The Alternative Investor. If you found this valuable, please be sure to like, subscribe, and share. This show is brought to you by Honey Hive Capital Partners. Visit us at honeyhivepartners.com to continue your alternative investment journey. This recording represents the views and opinions of its guests and does not reflect the views and opinions of Honey Hive Capital Partners, LLC. Nothing in this recording, nor any communications from it, should be treated as constituting financial, investment, legal, tax, or other advice of any kind, or as a recommendation to buy or sell an interest with respect to any investment. We look forward to you joining us next time.